Look, no one wants to go public. You probably know that.
Say more.
Everybody wants to blame the banks, right? They're just like, the banks
I would
don't
blame the banks. I'll admit it.
All right, leave the banks. I'm a former banker. I'll take the blame. The gaming of the system by sophisticated folks is partly to blame.
Can you say more? This is the insider baseball people come to the show for. What do you mean by gaming of the system?
And it leaves a bad taste in everybody's mouth if you way overprice. And God forbid the market's down the day you price, you could break price and the whole thing could collapse. When you have this feeding frenzy, you want to allocate to people who are going to sell, like they're going to sell up 15% or 20%. By concentrating all the orders, you're exacerbating the problem because you're just making a small group of guys hold all the cards. The big money wants to know what the smart money is doing, and the smart money always wants to do what the big money is doing. The CFO is the steward of capital for the company. The CEO is super important, but the relationship with the investors is built with the CFO. The buck stops there. The CFO has to become a solid communicator.
Is this thing on?
Yesterday's price is not today's price.
Welcome back to Run the Numbers. Today's guest is Jeff Bernstein, managing partner at Riveron, where he helps companies prepare for life as a public company or navigate the other fork in the road, M&A. Jeff's seen it all: banker, hedge fund investor, operator, advisor. If there's a version of the capital markets table, he's probably sat at it. In this episode, we dive into IPOs, dual tracks, SPACs, that rhymes, and what really happens when a CFO says, we're thinking about going public. Jeff explains why price discovery is so tricky in today's market, how IPO pricing is half spreadsheet, half relationship management, and why a book that's 20x oversubscribed doesn't really mean what you think it does. We also talk about the return of SPACs, what's changed, who's winning this time around, and the structural tweaks that might actually make this version more durable than the last, or not. Jeff shares what CFOs should be weighing in when evaluating the SPAC route and how to avoid repeating the mistakes or sins of 2021. And then we get practical. Jeff lays out the must-haves versus nice-to-haves for IPO readiness, how to build muscle memory for quarterly guidance, and investor relations before you're public, and the blind spots that even seasoned finance leaders still overlook. Plus, a few stories from the road: the sketchiest EBITDA adjustment he's ever seen, the metric a company once tried to pitch as their secret sauce, and the investor question that derailed a deal on the spot. All this and much, much more after a short word from our sponsors. Did you know that around 40% of manually processed invoices contain errors, missing data, bad codes, duplicates? And those mistakes don't just slow your finance team down, they cost you money. That's why global finance automation matters. It's not just about saving time, it's about keeping your business safe from costly errors. And that's exactly what Tipalti does. Tipalti is the serious AP solution for serious business. Tipalti automates the end-to-end payables process, handling everything from onboarding suppliers to global payouts, all so your finance team can breathe again. More than 5,000, of the world's most ambitious businesses already rely on Tipalti to make payments in over 200 countries and 120 currencies. With baked-in security and tax compliance, Tipalti gives you the confidence to scale globally without adding extra finance headcount. Give your finance team their time back. Don't let bad invoices drain good money. Visit Tipalti.com/runthenumbers. Tipalti.com/runthenumbers. Tipalti, serious AP for serious business. So if you listen to this podcast, you'll know that I am incredibly passionate about the FP&A space because that's the route I went to get to CFO. And I want to tell you about a tool that has exploded over the past few years. It's called Aleph. And I remember getting outbounded by them about 2.5 years ago, and I actually took the bait because they claimed to be able to do a demo with my live data, with me right there on the call. So I had to see it to believe it. And it was the founder running demos back then. Shout out Albert, hope you're listening. And he connected my NetSuite and built my P&L using their Excel add-in in like 15 minutes. And I was really impressed. Since then, Aleph has gone on to raise money from some of the top VCs out there, and they've built an impressive roster of customers. Many of their customers have been on the podcast, like the CFO at Turo, 8Sleep, and Zapier. They're all really big champions and supporters of Aleph like me. But it's not just an Excel add-in. Aleph also allows finance teams to work with their live cross-system data using Google Sheets and their web app. And that's cool because it gives teams the option to support a wide range of needs and workflows like budgeting, forecasting, and variance analysis. And speaking of variance analysis, they're doing some really cool things with AI-powered variance analysis. It basically allows you to figure out what's going on and why, and it takes the time that you'd usually spend from hours to minutes. It's really cool. So I highly recommend checking them out and taking them up on that demo or trial, just like I did back in the day. And you can learn more and get started at getaleph.com/run. That is getaleph.com. aleph.com/run. Tell them CJ sent you. A messy or missing cap table might not just slow you down, it could cost you your next fundraising round. VCs get flooded with pitches, and if your equity is confusing or missing, they'll move on fast. Fidelity Private Shares is an all-in-one equity management platform that helps you maintain a clean cap table, an organized data room, and a clear equity story. Schedule a demo at fidelityprivateshares.com. Mention Mostly Metrics and get 20% off. Jeff, thanks for joining me on the podcast.
Hey, it's great to be here, man. Thank you.
It's kind of like LinkedIn friends become closer virtual friends here, right?
It turns out we're not that far geographically, which is cool.
You're a couple blocks over from me. Now that I know I have an IPO expert in the neighborhood, I'm going to be knocking on your door on Halloween asking you for tips and tricks.
It depends what you're going to be dressed as.
My daughter, who's 4, told me that we're going as the Frozen cast. And,
excellent. What are you going as? Do you know what character you get?
I think I got Olaf, the snowman.
Okay. I got Shrek back in the day and didn't go well.
It's so funny. So right before this podcast, we did a podcast with old CFO of Disney Plus, and we went down memory lane on all the different Disney movies that were out there. And yesterday, for the first time ever, proud parent, I showed my kids Shrek 1.
And they love it. There's something about Shrek. It's totally lovable. And, Disney hit it right.
I'm glad to have you on the pod today. I thought just for the benefit of listeners before we kick things off, you've had an illustrious career here on all different sides of the negotiating table. Maybe you could just give the 30-second overview of how you got to Riveron and what you do there.
I'll talk about Riveron first. So Riveron is about 1,300 people. We got like 18 offices, mostly across the U.S. It's about 20 years old. We're owned by private equity. We have great owners. It's founded upon serving the office of the CFO and private equity, venture and growth equity, where historically we've served them on accounting advisory, finance operations, GRC and controls, business process improvement, tax. We do a ton of tech enablement, cap markets like I do in strategic communications, M&A services, and interim management. So really serving that kind of office of the CFO and the lifts that they have to take to improve operations, improve reporting, and go through a transaction. So for my business, I spend most of my time on go public transactions, and I came to the firm for this reason, because there aren't any firms that really can serve a company across all the pillars of readiness and execution when you go public, and it's tough to go public. So, you've got the accounting readiness, controls, compliance, the tech uplift, ERP, close, consolidation, reporting. There's so much that has to happen there. And then there's the Wall Street facing part of it, which is equally important, where you're crafting a public narrative, KPIs and peer group comparisons, the marketing to analysts, bankers, and investors, baking off and selecting the underwriters, and then building out everything, the quarterly model that you're going to give to analysts and so on. And so all of that has to take place in a reasonably short period. And I came to Riveron particularly because they serve so much of that back office side, or I don't want to call it finance operations side, where I've focused my whole life on the go public side with Wall Street. So I spent my career, I was not very good at it. I spent the first few years as a buy-side analyst looking at the telecom and early internet industry. I spent then 10 years at Goldman Sachs, taking tech companies public, and then ran a hedge fund for 13 years and then aged out of that. And I'm old enough now that I'm just an advisor. So I advise companies using kind of my background as an investor, pricing IPOs, and really just doing it all around the tech industry. So understanding business models, et cetera.
I love that. And I think you have an amazing perspective to bring to the table. And you've been on the banker side, hedge fund manager side, investor side, now the advisor side. If you had to look at the capital markets today, especially for tech companies, because many of our listeners are leaders at tech companies, well, what's the headline that you'd write?
I'd say do a turn on Mark Andreessen, where software was eating the world. AI is eating the world now, and that's probably the easiest answer. Software was eating the world. We witnessed an explosion of vertical and horizontal applications, and just the software stack has become so complicated, so burdensome, difficult to manage, expensive, et cetera. And now AI has this incredible potential to, in my mind, kind of unchain businesses from all of that software and allow them to really take control back from that dizzying array, which is really limited in its ability to be customized for every company's solution. So I think going forward, it's going to change meaningfully. And we're really seeing it really in kind of the growth rate of software, traditional software companies and seat-based companies as corporate CFOs really have to figure out the future. And the future is this, and it's very powerful. I think this is as powerful as the internet, if I had to say, make a big prediction.
I want to reflect on that because you've been there at kind of the start of a couple different, I'll call them waves here, because you had the internet wave, then you had the mobile wave, and then now you have the AI wave, and you've helped on transactions in all three of those waves. I know it's hard to do like when you're in the moment and it's exciting, but do you think this wave that we're in now with AI is bigger, smaller? How do you size it up?
I don't think it ever gets smaller. Look, mobile really unleashed so much. And I think that was just incredible in the way it allowed humans to be more productive in business in their personal lives. AI, at first glance, may not be as massive from a use case perspective in the very near term. But in 20 years, it's even though humane did make it, like it's all going to change. Like people's lives are going to change. Businesses are going to be able to react much more quickly, et cetera. So I think the capital markets are starting to realize that. The problem really is that right now, because we haven't had IPOs for like 4 years, there's a skittishness in taking big leaps from an investor standpoint and under a banker perspective, taking big leaps on early stage companies. And we've got a lot of them raising tens of billions of dollars that could go public at any moment, but there's a lot of reasons why they're not. And we're unwilling to right now buy the smaller companies that are really going to be huge at some point. But right now, the banks are leaning towards larger floats, larger ARR or revenues this time, but that's going to change in the next year, in my view.
I'm just like coming to this conclusion now. I didn't realize until I was hearing you go through it that a lot of the rounds, private funding rounds that are going on, like the likes of an Anthropic and OpenAI, SpaceX, they're raising much larger quantums of money than the few public IPOs, the few public offerings that we've had so far.
Capital intensity, man. Like software was not capital intensive. We are back to when I first started in this business, where technology really was about personal computing, then server-based computing, networking, a lot of very capital intensive stuff. And then we've enjoyed this run of spending on the softer stuff, which people just added back to EBITDA, like people. And so the metrics looked incredibly good from a return perspective. And ARR created this kind of smooth growth that investors love. So it's a lot chunkier now, but it's incredibly capital intensive. And these companies, therefore, are going to have to come public because private equity is not in the habit of underwriting massively capital-intensive businesses.
So we're going to hop into pricing IPOs in a second, but I've heard you use the term dual track process, and like my spidey senses went up. Does that mean like a company is preparing for the optionality to both sell or go public? Did I get that right?
Well, there's a couple. There's sell or go public, and then during the SPAC boom, it was sell or go public by an IPO or go public through a SPAC, which is a mini merger. But traditionally it means I'm going to think about either selling the company or going public. I may start an IPO process as almost a stalking horse or just to create some FOMO from buyers. A lot of the time when you run a dual track, you've already been out there trying to sell the company and you're not getting what you really want. And so you sometimes will say, as a private equity owner particularly, let's start an IPO track. Everybody's going to know it. And let's try and create some FOMO, because if this company's public, you're not going to, no one company's going to be able to ingest it, tag on some other portcos in there. And that often wins the day. I think growth-oriented private equity it's more common to run the dual track. I think for VC, it's rare. You just choose one or the other based on your perceived outcome, and we can talk about that.
Hey, thanks for listening. We'll be right back after a word from our sponsors. You just launched a new AI product. The new pricing page looks great. I'm talking crisp. But behind it, last-minute glued code, messy spreadsheets, and running ad hoc queries to figure out what to bill. Customers get invoices they can't understand. Engineers are chasing billing bugs. Finance can't close the books. Well, with Metronome, you hand it all off to the real-time billing infrastructure that just works. Reliable, flexible, and built to grow with you. They turn raw usage events into accurate invoices, give customers bills they actually understand, and keep every team in sync in real time. Whether you're launching usage-based pricing, managing enterprise contracts, or rolling out new AI services, Metronome does the heavy lifting so you can focus on your product, not your billing. That's why some of the fastest growing companies in the world like OpenAI and Anthropic run their billing on Metronome. Visit metronome.com to learn more. That's metronome.com. This episode of Run the Numbers is brought to you by Mercury, business banking for founders and finance pros who want their financial stack to actually work together. Now, I don't plug tools I don't know or intimately use. I've been a Mercury customer for a couple of years now. In fact, I showed the Mercury dashboard to their CFO, Daniel Kang, from their finance team right before we hit record on this episode. It felt like a full circle moment. And what I love most is that Mercury isn't just banking, it's operational confidence. I can send a wire to a podcast editor, I can check capital balances, and I can approve a payment for a freelancer who helped me with a tech stack report, all without bouncing across tabs or praying a PDF exported correctly. Mercury's making a bet on builders. Whether you're issuing your first invoice or wiring 7 figures for a warehouse build-out, it's banking that scales with your ambition. Visit Mercury.com to apply online in minutes and see why over 200,000, entrepreneurs choose Mercury to run their business finances smarter. Here comes my banking voice. Mercury is a financial technology company, not a bank. Banking services provided by Choice Financial Group, Column NA, Evolve Bank and Trust, members FDIC. The IO card is issued by Patriot Bank, members FDIC, pursuant to a license from MasterCard. All right, I got to get up on my soapbox for a sec here. Everybody's talking about AI-powered this and automated that. But here's the thing about revenue recognition. It's not just about moving data around. It's about getting it right, full stop. So RightRev is laser focused on one thing, RevRec that auditors actually trust. See, there's a difference between automating revenue processes and automating revenue recognition correctly. RightRev was actually built by the godfather of RevRec, who understands ASC 606 compliance, audit controls, data validation, and the flexibility needed for complex B2B contracts. We're not trying to be your billing system or your ERP. We're the revenue recognition engine that sits between your contracts and your financials, making sure every dollar is recognized correctly, on time, every time. Companies like Snowflake and Logic Monitor don't just need fast revenue reporting, they need revenue reporting that's audit ready from day one. And that's honestly where RightRev shines. And what I love about RightRev is they're not out there trying to be everything to everyone and just slap some, AI slop on top of it. While everyone is building these massive platforms that do everything in a kind of mediocre fashion, RightRev does one thing exceptionally well. They make sure your revenue recognition is bulletproof. Ready to stop gambling with your RevRec? Visit RightRev.com to see how we make complex revenue simple. That's RightRev.com, where revenue recognition actually works. I'm so glad that you're on for this because, from the outside looking in, I wouldn't have expected that there were really two different roads that some of these companies can go down. Because many of us, we just see in the news, Figma filed confidentially for its IPO, or I know Navan is on file, but we can't see the results yet. You don't think in the background that some of these companies have multiple paths that they can go down.
Look, no one wants to go public. You probably know that.
Say more.
Going public is expensive. You're basically at the whims of markets in terms of monetizing, for if you're a VC or growth equity or private equity, you get locked up for a certain period of time. The markets could collapse. It could hurt that the valuations could change dramatically. So you don't want to go public really, unless in my mind, it's critical for your brand and your validation as a global brand, or the founder doesn't want to relinquish control, or the company can get a materially better valuation in the public markets, which is sometimes the case. So I think going public, and that's why 10% or less than 10% of all companies that either sell or go public go public. Most of them sell. It's dramatically easier.
What's funny though is like on the surface they sound like vastly different outcomes. Is the real driver that hey, time's up, we need liquidity?
Yeah, time's up. That's it. Time's up. We need liquidity. I do think it's somewhat binary. There are just some companies that either become too large to sell. The brand is way too important to be taken private. It's consumer oriented. I'd say going public is a much better route, but you also want to have certainty. And that's why private equity chooses to sell, because there is a certain monetization path. And I think you're seeing right now the beginnings of both go public, sell process starting. We're not running any dual processes right now that are prescribed dual process, but everybody who's saying we're going to go public is hoping in some way that somebody comes in and pays a really high price for the company. We're doing, I'm just shameless, but Riveron, we're doing something with Latham and Watkins and Goldman Sachs in October 21st in New York City, a dual track process summit to really go through the pros and cons of each. And especially in the office of the CFO, what do you want to spend money on? Because going public, you got to spend money on a lot of things that you wouldn't have to spend on if you were being bought.
Jeff, something that you just said struck me, that you may be too large to be acquired. I think there are a number of companies that raised in the 2020 to 2022 era at valuations that are so big. They've built their ARR. They've become large as well. Like, you get to a point where the only companies that could acquire you are like Google, Meta, or like Palo Alto Networks. I'm just making it up. Like, there is such a thing as becoming too big to be acquired.
So there's those types of companies where the strategic acquirer base is limited. And there are also companies that have been owned by private equity for 7-8 years that aren't going to trade to another private equity company because they've squeezed so much of the orange that it just doesn't make sense. So they have to go public.
Let's talk about pricing IPOs, because that's how me and you met online. I love how LinkedIn can connect people in that way. And we were kind of trading some barbs around Figma's pricing. And some of the recent IPOs, like a Figma, a Circle, and a Bullish, they've had these like headline grabbing but tricky to nail down prices. Why is price discovery so much harder than it was like 10 years ago?
And as I noted in your LinkedIn responses, everybody wants to blame the banks, right? They're just like, the banks.
I would blame the banks. I'll admit it.
All right, the banks. I'm a former banker. I'll take the blame. In my mind, the issue really is there's a couple things. There's the social media seized on it and said it's the bank's fault. The process is broken. Others have said it's all because retail investors really want to own these things. And that's partly true. But for me, it's really other things. One is a lack of attractive IPOs over the last 4 years. So lots of demand for different types of companies. That's one. Two, a bull market. We've been in a bull market. So a bull market de-risks a lot of buying the IPO. And discipline on the part of underwriters, which we're going to get into later. That's a big one because they have to they can't price it at twice their peer group. Most importantly, I think what everybody's missing are the trading algorithms that all these funds have developed or purchased that are way more sophisticated than last time in predicting demand versus supply in a very short time frame that allows them to not only trade the IPO effectively on that first day, but also to drive like a feeding frenzy from less sophisticated investors who are also trying to get those short-term profits. That to me, is the one thing that people aren't realizing, is that the gaming of the system by sophisticated folks is partly to blame.
Can you say more? This is the insider baseball people come to the show for. What do you mean by gaming of the system?
Traders can sense through price movements and software and social media feeds and a whole bunch of other things what price people are willing to pay in any moment, okay? And they've developed these algorithms to get to buy or sell before all of that is realized by a broader base. And so when a stock starts trading in volume, there are a lot of folks who can read the tea leaves and predict with fairly good certainty the next 2 or 3% move in a stock. And because IPO day is typically the most volatile day of, outside of earnings or even including earnings, they play that volatility. And in a hot IPO where they know there's lots of demand, they will just play the greater fool theory. And I'm happy to do it over a beer with you to talk more deeply about it. But it's not going to be an easy solve. It's not. And we can go into that a little later as we dive deeper into how banks think.
Jeff, stupid question. Could direct listings partially help solve this?
You can solve the structural issue and better optimize for demand and thus raise the proceeds you get, for sure. I mean, direct listings have done that. But what you're giving up on the back end is a lot, in my opinion, because in the end, you want to be widely held by large mutual funds. They hate direct listings because they end up paying top dollar from other people who are putting demand in at different prices, et cetera. And so they've been burned before by paying that. So they find the practice kind of piggish, and they don't even therefore do the work on a direct listing. And it follows through. They retain a bad taste in their mouth that the issuer was greedy. And so they don't even dedicate resources to the company in the first 6 months. So I think it's kind of short-sighted. It also brings a lot more work on the part of the company because the banks in a direct listing are really limited in their ability to market the transaction. The company has to do all the meeting prep and all of that stuff themselves. They can't onboard research analysts as easily to cover the company. It's marketed as being less expensive. It ends up being way more expensive. So I'm personally not a fan. If we want to fix the process, I think there are some things that can be done that we can talk about as we get into kind of how pricing works.
So just to play back what I'm hearing, the direct listing, it overly benefits the issuer potentially within the ecosystem.
And it can sometimes lead to an initial valuation that nobody wants to get into, right? If you're a very large mutual fund or a large hedge fund, no matter what it is, you expect, because the company does not have a long history of public reporting and quarterly reporting and guiding, there's a significant amount of risk that you're taking as a public investor, that you're going to hold the company and first quarter out of the box, boom. Now, I'm not going to blame Figma. Figma had a decent quarter, but look at Figma's IPO. We can get back to the whole up 150%. If Figma would have priced to demand and then reported the quarter they did just the other day, last week, you would have had institutional investors holding the bag on a reversion to the mean because Figma smartly reported that quarter, very good quarter, kept their guidance, and everybody was like, wait a second, you're supposed to be way above all of that. And they worked. Now, would I have guided them differently? A bit. But the fact is that the underwriters did not price it like a direct listing to solve for demand, and where, all the big future shareholders were paying an inordinate price that was well above what the peer group would trade at. And you don't want that. You don't want that as a public company. You want to earn the trust of investors long term.
You said that more eloquently than I could. What I'm trying to piece together in my head is like, the point of an IPO from many people's perspective is like to put cash on the balance sheet. Like it's just another form of fundraising if you look at it that way, and to give liquidity to employees. I guess like there is the other angle of who's picking up the shares on the other end. So how do you find a middle ground that's fair to everyone? Like if you're an employee of Figma and you're sitting there and you see the stock go through the roof over 150%, and you're like, well, I'm locked up and we're seeing it fall a bit already on the backs of the last quarter's earnings. You're kind of like, well, some of those institutional investors probably, or hedge funds, got in and out pretty quick and made some money before I did.
It's a very good point. If you're an employee, let's say it's the other way around, and you do price it at an exorbitant amount, way above the peer group, the employee gets $1 billion, $2 million, $3 million. And they're like, you know what? Time to go to a new company. I got a great valuation for my shares. So I'm out. Let me trade to something different. I'm not saying that every employee is going to think that way, but I think that to attract and retain great employees, it's in your best interest, one, to not let them sell too much at the IPO, and to earn your valuation over time that keeps them there and keeps them interested in continuing to create value for the company.
Take us behind closed doors. How do banks and companies actually hash out the right IPO price? Is it spreadsheets? Are they shouting at each other? Is it a little bit of both?
It's mostly spreadsheets. I've heard some shouting.
And how much of the price is determined the day of? And so, like, just to make it more real, I'm pretty sure someone like a Figma, they didn't start trading till like after lunch Eastern time, right?
They didn't start trading there, but they priced the IPO before the open. Okay, so the IPO was priced, and then they go through the process of demand and supply for that opening trade. And that is a science. That's more of a science than an art. But going back to the actual pricing of the IPO, that's done ahead of time. As you know, orders come into a book during the roadshow. Often the bulk of the book isn't really built until the last 2 or 3 days, i.e. demand comes in, it creates more demand, you're meeting with more investors, you're building more demand, etc. You're then, as the capital markets group of the bank, you're going out and saying, look, we're 11 times oversubscribed. It looks like we're going to price at the top of the initial filing range. And then if it gets crazy, you have 20% upside. You can increase the range by about 20% before you have to refile. And so then you have to make the decision as to whether you want to raise the price, and then you communicate that, and that creates even more frenzy. So banks underwrite not for day one. And I talked about this before. They price for the valuation relative to the peer group and what we call a seasoned valuation, meaning after they report their first quarter and the stock starts to season. That's what they're pricing for. The problem is, and it's in no one's best interest to price an IPO at 2 times the valuation metric. One, it's an invocation for SEC scrutiny. You know, you could get sued, and it leaves a bad taste in everybody's mouth if you way overprice. And God forbid the market's down the day you price, you could break price and the whole thing could collapse. And that's something nobody really wants. So the pricing talk is evolutionary. The problem is that it is an art, it's not a science. And the problem then becomes, as everybody starts to get the darn thing is heating up, the funds will say, you know what, I told you I was willing to pay 19 for $1 million. I'm in for $1.5 million at 20. I'm in at $2 million at 21. They start to, because they want stock, they're playing with the house's money at that point, right? The stock's going to trade up for sure, and they're getting free money at that point. But there's no way the bank can know exactly where it's going to open, because frankly, the funds are giving them not false information, but they're inflating their real demand and price.
So there's a bit of liar's poker going on there.
A lot of liar's poker. And I'm not calling I was a buy side. It's when I was allocating IPOs back at Goldman Sachs in the old days during the .com bust, it was a constant issue, a constant problem in that we'd receive that feedback. And then when I got to the buy side, I realized the only way I'm going to get a lot of stock on this deal is not only to say I want this, but also I was going to have to show it to the underwriters that I was willing to buy some in the aftermarket. So if you give me 50,000, I'll buy 20,000. There was a lot of gamesmanship that happened. Yes.
Let's talk allocations. There's the official story of like that companies here, and then there's the back channeling and horse trading. Well, what does that look like on the inside?
Allocations. So once the frenzy starts, right? The frenzy starts, it's 10 times oversubscribed, 11, 12, we're raising the range by $1, 18 times, etc. The banks then go, oh my gosh, we've got this incredible problem. They tell the company says, well, all these people are inflating their orders, etc. And the natural response by the bank is, well, we're going to zero out 50% of the orders because we know they're fake or not real. They didn't meet with you. They didn't do any work, etc. And we're going to give another 25% or 30% of the people a fraction of what they want. So they concentrate the order book on the allocation side. That means that it creates even more of a frenzy when the stock goes to open because you concentrated the book, you gave tons of people zero. Some people know it. Some people actually want to buy stock. They're willing to do it, but there's going to be fewer shares available to sell up $2, up $3, up $4, up $5. And you start getting into this problem where the guys you gave stock to, it's tough to pry it out of their hands. They own it. And so it starts inflating the price at which they are willing to sell. That's just, stock. So the stock ends up trading up huge because the sellers are just know they have it all in hand. And so then the problem is you priced it at 20, it opens at 40, and then the guys you gave stock to go, I can make 100% risk-free right now by selling, or I'm going to hold the stock at an unreasonable valuation. So they end up selling. And when you get that first 13F report back, 45 days after the quarter, you see your shareholder list, and almost, very few of them were the people that the bank allocated all their stock to. So it ends up making everybody unhappy.
Yeah, I would feel kind of snake bitten if I looked the 13F report and saw that the people that I carved out a stake for aren't there anymore.
This is where the process, in my mind, this is where the banks can get better. Okay. The banks tell companies generally at the beginning, we are not going to allocate to hedge funds. Boom. They're mean. They're going to go short your stock, etc. When you have this feeding frenzy, you want to allocate to people who are going to sell, like they're going to sell up 15% or 20%. By concentrating all the orders, you're exacerbating the problem because you're just making a small group of guys hold all the cards. In my mind, if you allocate more broadly and you want it to trade a lot more and you've got more people who are willing to take a 25% profit right away rather than waiting for that 100% profit, the clearing price actually comes down, the stock trades a lot more, and even your big guys that you allocated to said, look, I just got half of what the position I really wanted at the IPO price. I'll pay up 15 or 20% to start filling out my position. To me, strategically and tactically, I don't love the idea of in a hot IPO of really concentrating the allocations. I think it's a mistake.
You said something very astute there that may be counterintuitive to people, but you do want some people to sell your stock. You need float and liquidity.
You want people to sell your stock in a hot IPO. When it's not a hot IPO, then I completely understand wanting it to allocate it to people who have done the work and are willing to own it at the clearing price. But in a hot IPO, I think you want it to trade. I think you want to allocate it much, much more broadly than they do.
So when a book is 20x oversubscribed, we've all seen the headlines, what's really happening behind the curtain and deciding who gets the stock and who gets left out? Is this relationship management on behalf of the bank?
I mean, that wouldn't be really fair. The bank's doing a really good job. I'm not going to call it out, but when a book is 20 times oversubscribed and you're a really big client of the investment bank, okay, and a lot of funds hold big balances there, custody, prime brokerage, all of that stuff. It's not good for the relationship even if they didn't do the work. It's not great for the relationship to give them nothing, right? And you do, in my mind, you want stock to be sold. So I think relationships play a part, but it's not a big part. The biggest part is, in my mind, the bank's ability to go back and say, who are the most trusted relationships we have? which are the long only funds always sell, and which are the ones that always just wait for the stock to come in and then buy more. Which hedge funds are the ones that flip automatically, and which are the ones that really do the work and really want to own the stock. And those relationships of the customer telling you what they're going to do and then doing it, that's the way to allocate. Coupled with, obviously, the density of work that's been performed, whether the analyst or portfolio manager is seen as a thought leader. Like when I was back in my old Goldman days, I would always say the big money wants to know what the smart money is doing, and the smart money always wants to do what the big money is doing. So there's a symbiotic relationship there that is very important. So a lot of the best analysts are at hedge funds, and they are followed by a lot of the mutual funds. Similarly, a lot of the mutual funds have guys there that have been there 25 years and just have a way of just finding the right companies. And so the smart money wants to know what they're doing, et cetera. But the banks have to know, the syndicate manager, and the big banks are can be very good at this, understanding where the truth is, to me, is the key.
Jeff, in your experience, is there a rule of thumb for how much you want to be oversubscribed, like a ratio?
Not really. I think for high growth companies, 10x or more is great. If you're offering 200 million, like a relatively small IPO, and you're not 10 times oversubscribed, I think you're going to have a problem. If it's a $2 billion IPO, that number can come down fairly nicely in terms of level of oversubscription.
If listeners have been reading the headlines, SPACs are back, baby. So what is going on? How have these come back from the dead, and who's winning in this version?
Oh boy. Partly because of what we were talking about. SPACs have reemerged, partly because there's currently a pretty high bar for going public through an IPO. If you've seen the last, this year, most of the IPOs are at least 500 million in size of the float. So that's a big number. So if you can't float 500 million, but you need capital, the SPAC is an alternative. Secondly, if you need to float 500 million, you have to be a significant scale already. So companies that aren't really at that scale or are not yet aren't close to profitability. The banks right now aren't willing to do that unless it's a very, very special company. And so SPACs have reemerged as a viable way to go public, potentially get cash on the balance sheet if you can minimize redemptions or raise a pipe, and go. And companies are doing it.
Have any of the structural guardrails changed since the last wave?
There are some new guardrails that are important. The most important, I think, is that the target company now has to be a registrant with the SEC. In the old days, only the SPAC registered. So now the company is on the hook for statements for like stuff they put out there. They can, the SEC can bring action. So that's one thing there. And the result of that is that what we're not getting anymore is where a company goes to a SPAC and puts out a 5-year forecast when they're only doing 60 million in sales and they have no clue how to really, it's not forecastable. So companies now that are going the SPAC route are pretty much doing the same thing and the registration requirements, the disclosures are much closer to an IPO than it used to be. So companies, the only thing they can do that's different than an IPO is instead of when a company goes public through IPO, they give their model to the analysts in the syndicate who then publish. You can still put out there a forecast, a quarterly forecast, or maybe an annual forecast, but you're really, we advise companies, you give this year, maybe this year, and now that we're in the second half of 25, give 26. That's it. And make sure you're conservative.
So if I'm a CFO, what are some of the other considerations that I should be wary of when evaluating whether I should go that SPAC merger route?
Well, first and foremost is that if you need cash, there is no guarantee that you're not going to have 100% redemptions and therefore not get any of the cash in trust. There's no guarantee you can raise a pipe to offset some of that risk. So what we're seeing now is that the valuations that the SPAC is placing initially on the company is much more conservative. And that's much better. Okay. That's much better because then people are going, oh yeah, this is worth $11 a share, not $10. And whereas you couldn't justify any of those initial valuations. The last time it was just kind of stupidity in my mind. So one of the things is that you have to really be honest with yourself as if is the valuation compelling enough that people aren't going to redeem or that you can raise that. Secondly, you have to be, because it's a sprint and it's a faster sprint than an IPO, financial readiness to be public is always the long pole of the tent, along with audit timing. Are you really ready to be a public company? Just because the fire is hot and you got approached by a couple SPACs, if you're not ready to be a public company, you're going to miss one of the first 4 quarters out of the box, and your stock's going to go and trade. It's going to be a penny stock. And it's because because the float isn't going to be that big, the risks of missing a quarter are much higher than if you did an IPO of $1 billion and you missed the first quarter. You're still going to have a lot of float, but you'll have, as a public company, you will not be able to raise capital in the public markets if you miss one of the first 4 quarters.
I'm glad you brought that up. We're going to talk about what it means to be ready. 2 more questions, though, real quick, just to reflect on SPACs and in their current state and what we recently saw. I guess the first question is, do you think that the SPAC structure self-selects for companies that have some hair on them, or is that a misnomer?
When you think about the most successful SPACs to date, very few of them had dramatic hair on. The 2 that I can point to that I think have been among the most successful, one is RightRev, which was a cooling and power company for data centers. I think they went public in 2020. They were already a $4 billion revenue company, but they only grew revenues 5%, and they weren't very profitable. So they were a great candidate for an IPO in 2020. Goldman Sachs, who had the SPAC, and the company, which was owned by Platinum Equity, brought in a really strong CEO. It was a great SPAC because it wasn't hair. It just didn't have the characteristics of an IPO from a growth plus profitability. I mean, it's okay to be growing 10% if you already have 15% operating margins or EBITDA margins, but you need one of those. So it was a great SPAC. And now it's an $8 billion revenue company, and earnings have exploded, obviously, because of the demand for compute. The second one, on the other hand, was, in my mind, DraftKings. DraftKings went public via SPAC.
I forgot that was a SPAC, Jeff.
Yes, it was a SPAC. And, sports gambling had just been deregulated, but institutional investors and investment banks were still I don't know, it was still not seasoned. Gambling, had hair. And, there were some fiduciary risks of being a bookmaker, even though banks' IPOs is like bookmaking. But DraftKings was a company early in a trend that was benefited by deregulation, that created a great business model, but where an IPO and the diligence required by the underwriters might have been too severe and take too long when the iron was hot at that time.
Who do you think has been the most successful SPAC to date from a results perspective?
Those are the 2. I mean, those would be my 2. They've just become great businesses. Well, one was already a great business, but those are the 2 that I really think have defined what a great SPAC could be. One is not growing fast enough, but has tremendous potential long-term for return on invested capital. And the other is something where institutional investors are just a little skittish. And the underwriters are just a little skittish, but they are at the beginning. They're not at the beginning. They have created a business model in a sector that isn't currently accessible in the public markets, but the banks aren't willing yet to underwrite that business model because of regulatory or whatever.
Let's talk a bit about public company readiness, which you already teed me up for. We were talking and you described the must-haves versus the nice-to-haves on this path to IPO. Can you map out that timeline for a CFO who doesn't want to have to learn the hard way?
If you look at, let's just take IPO as T0, you have to kind of, the latest you can kind of choose banks, your lead underwriters, to start drafting an S1, which is going to go through 2 or 3 comment periods by the SEC, each of which takes 30 days. So the work back is you need to be able to select banks, in my mind, about 6 or 7 months to start the drafting process. You then have to have your PCAOB audit ready, as you know.
So basically, you have to go through an audit that's probably a bit deeper.
You have to go
than
through a
private
more
company.
diligent audit. The PCAOB audit is a more diligent audit. You may have to move from AICPA or IFRS to US GAAP. And so all of that has to be, and with PCAOB, you have certain internal controls that have to be remediated. You have to be ready for that for the first initial filing of, it's a confidential filing, but it's going to be about 4 to 5 months before the actual go public date. So the audit is the long pole in the tent for sure. Companies often think, it's funny, companies often think that SOX compliance is the must-have there, but it's really not. You really, the key is that's a one. So you've got to have that ready. And I can't tell you how many times companies have come to me and said, we want to be public in 6 months, or we want to be public within the year, but they literally they still have 22, 23, and 24 audits that are not complete. And they have to step up to PCAOB, and they might be not an emerging growth company, so they have to provide 3 years instead of 2 years. And we could talk about that if you want, but that's the long pole in the tent. The second biggest one, and is often overlooked, is building the internal muscle to be a quarterly reporting company. And that is critical to long-term success. There are hires that you have to make, not 3 months before, but 9 to 12 months before, to beef up your FP&A team, to bring in SEC reporting people. There's just a tremendous amount of muscle internally that has to be built. We get hired when that muscle isn't there to give them temporary muscle and hope that we're going to get fired at some point soon. The last thing is your ability to forecast your own earnings. You're going to have to put forecasts out there to the analysts who are going to follow you. They're going to then publish research a month after you go public with a quarterly number. And if you miss any of those, you're in trouble. So you have to have a guy whose philosophy. You have to make sure that your quarterly forecasts are conservative. And so you have to build that out with certainty. And that's tough. You coming from FP&A,
I know we're just scratching the surface here, but if you'll humor me for a second, how do you coach finance teams to build that muscle memory of being public?
2 cohorts. One is venture-backed founders who have been in the business of raising money for years and years. They have been paid to be optimists without a lot of need to prove anything short term, right? You got the vision, you got your cohort analysis, you got so much there, but you then have to turn that company into a conservative company. And the CEO founder is not used to that. So that often takes a lot of coaching. The second is the private equity owned company, where the CEO and the CFO don't meet with investors. They just meet with their one investor and have not had any really interaction with the narrative that they need to have to be a public company, how to kind of jawbone short-term versus long-term goals and results. So you have those 2 things, and we do a lot of coaching around that. The second is on the numbers itself. I cannot tell you how many companies just do not want to be conservative enough around their forecast. The higher your growth rate, the more you're expected to beat this quarter, and the more you're expected to raise the next year's or the current year's earnings forecast. We have a matrix that we have followed where we every quarter we look at companies growing 10%, 10 to 15, 15 to 20, 20 to 30, et cetera, and what the stock reaction was before and after they reported earnings based on their guidance and the amount that they beat by. It's a very important lesson. Often managements don't want to play that game, but they have to. You have to earn the trust of investors over the first couple of years if you really want to build a great public company.
Jeff, those are like 2 completely different personality types or ways of doing business that you have to coach. Like, I'm thinking about like the venture-backed CEO who's pitching $100 million in revenue when they're at $1 million, and they fully believe it. And then I'm thinking about the private equity back professional CEO who is wearing a belt and suspenders each day.
Yeah, very different people. I think it just comes down to, are these people, and again, we're all, I'm an old dude, I'm 64, and I've learned this over time about myself. Am I comfortable taking advice from people I trust? And this is where folks like me come in, because it is important that to learn how to communicate with public investors. And I'm not trying to change people's personalities, but I'm trying to hopefully make them open to how earn the trust over time of investors. As you know, a lot of CFOs are fairly not shy, but they're not used to making a lot of presentations. And that's why companies often hire a public ready CFO to go public with. And there's other reasons why they hire that person. But the CFO is the steward of capital for the company. The CEO is super important, but the relationship with the investors is built with the CFO. The buck stops there. The CFO has to become a solid communicator.
Jeff, do you think that the storytelling skills for raising money in the private markets are different than the storytelling skills for the public markets?
Well, you get a lot of leeway as a private company. You don't have as much leeway as a public company. So your storytelling is more visionary. Even when I advise private companies, because we advise private companies on their fundraisers as well, we try to get the CEOs and the CFOs to lay out a story that has short, medium, and long-term to it. I think if you can do that, you also have a better handle on your business in general. If you can lay out the short-term opportunities and risks and how you're both from a technology build, operational build, financial build. If you can get all of those three together and keep practicing it, I think that is going to help you not only raise money, but operate a business with better stewardship.
Jeff, gearing towards a close, I'm going to take you into what we call our long ass lightning round. And this is really just a selfish opportunity for me to ask you for stories from your career. And so the first one I want you to humor me with is, what's the most overhyped metric you've seen a company try to sell as their secret sauce?
Back in the early .com days, we didn't know how to position a certain company. They had incredible depth of talent there, but it was very early stage. I can't name the company. We came up with a metric, and it ended up being a very successful company. We came up with a metric on market cap to number of PhDs to show, because we knew that the company had incredible brain power, but they still didn't have their business model fully fleshed out. It was a software company, ended up being very successful, but we didn't have a lot of metrics. So that was one. The second one that's been widely used and, was early on is, to me, it was eyeballs. How many people visited my webpage? That was early on, before monthly user, daily user, all of that. It was eyeball, who just touched my page like that. And it used to be valid, right? But not sustainable. So that's my second one. I can get into a lot of overhyped things. Like, there's some metrics that in my mind are not long-term facing.
Give me one. What's a metric that's not long-term?
I think a lot of the dollar retention metrics before you are at scale and growing, and you're growing really quickly, can be misleading. So I'll just leave it at that.
Sketchiest EBITDA adjustment you've ever seen?
Sketchiest EBITDA adjustment. That's an easy one. The greatest one ever was a company called WeWork, and it was called community adjusted EBITDA. So they subtracted interest, taxes, depreciation, amortization, and marketing, G&A, development and design costs, community adjusted EBITDA. To me, that takes the cake. There's so many things that people try to get through audit, et cetera, and to the markets that are recurring costs that they try to count as one-time costs. There's just a lot. I'm not calling them sketchy, but I don't think they should be used by investors a lot. I don't like when people try to write off CAC, for example. I think you're going to see a lot more, especially in the compute world and AI, excluding a lot of capitalized software development amortization by claiming it's non-core, even though it's really ongoing R&D. I think could be problematic.
Jeff, I've noticed a new wave of fintechs and buy now, pay later companies trying to adjust out any credit losses.
No. Really?
Yeah, like it's core to your business. How are you going to say that like what we do and when we don't do it well, we get to subtract?
Yeah. Credit losses. Yeah, that won't hurt at all long term. I'm dying to see. Do you have a company that's been doing that? Is it any of them coming public soon? Starting with a K? I don't know.
Klarna was playing it fast and loose. I'll leave it there.
Yeah, I don't know what a firm does. I don't think a firm does that.
What's the most uncomfortable situation you've ever been put in during an IPO?
I knew this question was coming. And this is back in my days at Goldman, running IPOs. One of our biggest clients at Goldman Sachs was at the time a very large technology-oriented hedge fund with a very outspoken head portfolio, the guy who founded the firm. We brought in a company with a relatively new CEO who came from a slightly different industry than the company she was in, now the CEO of. This company has gone on to become a household name. We bring her in for the roadshow meeting, and he must have been having a bad day. He proceeds to tear her apart in the questioning, like, how can you be put in charge of a tech company? You come from the consumer end, et cetera, et cetera. He starts asking her about her past, things you would never, ever ask now in a meeting. She stayed stoic throughout. Walks in, we get out of the meeting, we walk into the elevator, and she says, if that effer gets 1 share of my stock on this IPO, I will never do business with Goldman Sachs ever again. Now, again, this was one of our largest clients who was known as one of the top technology investors of all time. And I had to then go tell him that he was getting 0.
How did that go over?
No.
Like a lead balloon?
He cut off trading with us for a month or 2. Ended up, by the way, becoming one of the largest shareholders of the company a year late.
My goodness. Thank you so much for lending your time. If people want to find you, where can they do so?
Find me on LinkedIn, Jeff Bernstein. I'm the head of capital markets and strategic communications advisory here. We love clients that are thinking about a public transaction. We can do the work. We can really help you get there quickly, as quickly as possible, manage all those cohorts of lawyers, auditors, bankers, and investors, et cetera. So look me up. And if you live in Fairfield County, Connecticut, let's go watch some football.
Run the Numbers is a mostly media production. Yelling and intro by Fat Joe. Artwork by Meg D'Alessandro. Show is executive produced by Ben Hillman. Nothing said on this podcast is intended to be business or investment advice. It's the sole opinion of me, a guy who feeds his dog way too much ice cream and has a history of net operating losses. LOL. If you like this podcast, hit subscribe and give us 5 stars. It will take like 2 seconds and our algorithm overlords love it. Drink water, call your mom, and have a great day. Peace.